Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Jack Large, editor of CTMfile, and Ben Poole, writer at CTMfile. Welcome back, Jack and Ben. Thank you in abundance for taking the time to share your thoughts with us on topics that impact the world of treasury management and beyond. Let's dig deeper and get your perspective on our topics for today, namely Bank of America and Citi Group's income projections differ from the US Federal Reserve's stress test results, UK business confidence rebounds to a 13-month high, the European Commission proposes a framework for the digital euro, UK investors intensify switch from equities to fixed income, and compliance in the spotlight in an era of expanding regulatory scrutiny. Our audience can read articles, interviews, and industry roundups by visiting ctmfile.com or by following the links in our show notes. Let's begin today's discussion with our first story, which is about Bank of America and Citi Group questioning the US Federal Reserve's projections for their future income, the latest sign of tension around these US central banks' annual stress tests. Both banks said they are in discussion with the Fed after their own estimates differed from those of the US Central Bank. The results of the early exams and projections are closely watched because they are a key factor in determining how much banks can return to investors in payouts. The tests also determine whether the large banks have enough capital to weather a significant economic downturn and maintain a normal customer lending capability. The stress test evaluates the resilience of large banks by estimating their capital levels, losses, revenue, and expenses under hypothetical scenarios over 9 future quarters. While the Fed stress test has found that the top 23 banks in the US would remain above their minimum capital requirements in a hypothetical recession, and that may be regarded as a positive sign for the industry, Jack, do you think from a corporate treasury or a corporate banking perspective, is there anything that you find to be of concern, given that 2 of the 4 largest banks in the US are questioning the Fed's projections for their future income?
Quite interesting, this. Big banks have nearly always questioned the results from stress testing. What I take confidence from is that 2 different players have got different results. 2 major players have different results. So it shows that the tests are exposing different things. I take confidence from this, but it also shows that corporate treasurers need to take care at having excess funds in any one bank. There are levels of excess bad lending and various other excesses which are always going to catch banks out. I would not put everything in one place.
That's a great point, Jack, in terms of diversifying your banking group to sort of mitigate that counterparty risk that has definitely been a big issue this year. And Push, as you said in the intro, obviously this year's test did show that the major lenders, including B of A, have enough capital to weather a severe economic slump. That triggered many to issue share buybacks and dividends almost immediately. So Citi, Goldman Sachs, JP Morgan Chase, Morgan Stanley, Wells Fargo, they all hiked their third quarter dividends last Friday as a result of this. But B of A's announcement didn't materialize until last night. So it did have a knock-on impact on the bank. I just find it really fascinating that Bank of America's own analysis implied a much worse result than the Fed's test. So it's kind of understandable that they'd want to get to the bottom of why those 2 different numbers are out there.
Let's move forward to the second news item for today's discussion, which is about UK's business confidence rebounding to a 13-month high in June as firms shrugged off another Bank of England interest rate increase, a survey by Lloyds Banking Group found. Business confidence bounced back in the first half of June, increasing by 9 points to 37% in the Lloyds Bank Business Barometer. This represents the most significant monthly rise since March 2023. Despite last month's interest rate rise, the increase was primarily driven by rises in firms' view of their trading prospects and optimism on the broader economy. Ben, from a corporate treasury perspective, would you agree with the Lloyds Bank Business Barometer that highlights increasing business confidence and economic optimism in the wider UK economy, or would you disagree?
Well, I think business confidence is always good because it sort of opens up the toolbox of what treasurers can do. It means you can be potentially a bit more positive in perhaps your cash management, perhaps your investment portfolio. I was quite interested in some of the drilling down into the numbers in terms of sort of regionally. We saw that confidence in 10 out of the 12 regions and nations of the UK were up. So the East Midlands jumped 35 points to 52%. Scotland jumped 28 points to 50%. And they were like the top two in the regional poll. It was only London and the Southwest which actually recorded falls in June. And the business confidence specifically for firms in the service sector rose to 37%. That was up 11 points, highest since February last year. And manufacturing firms, this is a really interesting one, I think. Their confidence increased to its highest again since early last year, up to 50%, which is up 10 points. Which is fascinating because the UK Manufacturing Purchasing Managers Index, the PMI for June, that actually fell to a 6-month low of 46.5. So as a sector, it's contracting at an increasing rate and yet confidence is going up. So, I think perhaps the truth is somewhere between those 2 points, but I would say it's promising to see business confidence rebounding. What I would say though is that obviously with interest rate rises and cost pressures are still felt by many in different industries and sectors, and this score doesn't take into account the impact of the slightly surprising 50 basis point hike by the Bank of England last month. So expectations for average pay growth, although slightly down this month, appear to have picked up again compared to the start of the year and remain elevated compared to the pre-pandemic levels. So I think really what this result shows is that there's a remarkable resilience in British business to the stresses that it's been put under in recent times. But unfortunately, there is a lot more pain still to come down the pipeline. So it's how well it can hold up in that scenario. So I think if I was a corporate treasurer, particularly, with UK, British interests, it's time to be, cautious. Even though the optimism is going up, don't just immediately open the floodgates and start locking yourself into positions that you can't get out of.
Let's move forward to the next topic for today, which pertains to the European Commission, or the EC, proposing a framework for the digital euro. Amid a flurry of recent announcements, the EC has announced a legislative proposal establishing the legal framework for a possible digital euro to complement euro banknotes and coins. The EC says this would ensure that people and businesses have an additional choice on top of current private options that allows them to pay digitally with a widely accepted, cheap, secure, and resilient form of public money in the euro area. Jack, while the European Commission has announced an ambitious legislative plan to establish a digital euro, what do you think are the most important issues they would need to address before a digital euro can transform digital payments within the EU?
I think they've addressed one of them, which is the privacy of the payment system itself. There were some eloquent words about secure and resilient form of public money in the euro area. The consequence for corporate treasurers are, first, they have to acknowledge CBDCs are coming. And most corporate treasurers will have to accept digital euros. The smaller companies, the small shops and so on, may not take digital euros initially, but corporate treasurers, the scale of what corporate treasurers cover, mean that they have to accept they're coming. And the question for them in Europe, which is to be applauded for the framework, the privacy framework for the new systems being envisaged, is that treasurers have to work out how to exploit the opportunity. This is both a stumbling block, but it's also an opportunity. It could cost a lot of money without you getting the required volume of funds to make the investment worthwhile. It needs to be studied on a company by company basis.
I think that's a really good point from Jack there. And also what it's doing is adding yet another payment channel for treasurers and corporates to manage, because it's worth noting this isn't the end of cash in Europe at all. In fact, the EC also at the same time put forward a legislative proposal on the legal tender of euro cash, which it said was to safeguard the role of cash and ensure that it's widely accepted as a means of payment and is easily accessible for businesses and individuals across the euro area. So it's not a case of switching one payment channel for another. It's being able to make sure you can interact with suppliers, business customers, and sort of end consumers in as many ways as possible, which is, it's an interesting thought to have. We've got all these CBDCs globally that are being developed with proof of concepts and trials. And there's not many that are interoperable. There's two, I think, very interesting interoperability proofs of concept that are going on. That's where I think the trouble might happen. And you might have to have some sort of consolidation or a platform that can sort of allow you to easily view every CBDC that you're dealing with. But I think by releasing the two proposals, the one for the digital euro and also one for banknotes and coins at the same time, it also shows, I think the EC understands that a CBDC requires people's trust and confidence. Mm-hmm. And I think this proposal probably helps frame the debate around what a digital euro is. And the EC will be hoping also sort of champions the advantages of creating it.
This also raises these two documents raises an issue that's going to become more and more important to corporate treasurers, which is you're going to have growth in one area of payment systems and decline in another area, and they're going to have to manage this. And at some point, a bit like airlines stopped accepting cash on planes, we're going to have to do the same thing in business more generally. And that's going to become an increasing problem.
Particularly as the EC is kind of specifically stating that member states will need to ensure widespread acceptance of cash and sufficient access to cash, and that they'll be monitoring this and say that they could step in with specific measures if needed. So it's a bit of a headache, I think, potentially for corporates.
Agreed.
That's a fascinating analysis, Jack and Ben. And I hope our audience was particularly paying attention to the important points being privacy, security, interoperability, alternatives in terms of switching from one to the other, as well as other concerns that CBDC or the digital euro needs to keep in mind. But I think it's a great beginning. The fourth topic moving forward is about UK investors accelerating their flight from equity funds into fixed income and money markets in June, according to the latest fund flow index from Calastone. UK investors withdrew £662 million or US $842.2 million from equity funds during the month of June, the largest outflow since the market convulsions of September 2022. June was one of the top 10 worst months for equity fund outflows on Calastone's record. Ben, why, in your opinion, is the flight from equities to fixed income happening?
Well, I think Edward Glynn, who's head of global markets at Calastone, hits the nail on the head with his quote that's in this story, which is that this is a flight to safety. Obviously, you can get higher expected returns investing in equities, but you're also accepting higher risk when going in that direction compared to fixed income. So you think of a market, take the UK property market, for example, which it's another example of sort of remarkable resilience considering where mortgage rates have been pushed to in the UK, but it's not within, the realms of possibility that we'll see potentially a crash in value in that sector. That's one possible outcome. So there's a lot of risk. There's a lot of talk about potential recession. There's a lot of sort of negativity that's sort of brewing. You can sort of feel it coming. So I think a lot of investors are kind of getting a leap on that happening, moving to fixed income, which also opens up the chance for them to get regular interest payments, which is kind of not the main reason for doing it, but it's like a cherry on the cake with rates increasing. And being able to lock in high rates can also insulate investors against potential rate cuts. Not that we know when we'll be getting rate cuts, probably not for a little while yet, but it just means that you're able to take advantage of the investment situation that you're presented with. And of course, one final point is the value of money market funds is well known by corporate treasurers for their easy access to cash and ability to quickly reflect interest rates when they're going up, particularly, which makes them even more attractive during sort of the hiking cycle that we're in. And of course, in the banking turmoil in the first part of the year, that also brought up that spectre of counterparty risk that I mentioned earlier. So it really makes sense, I think, that investors have added, 2.44 billion to money market funds in the past 12 months?
Yeah, it's no surprise to me. It shows how cautious investors are becoming more generally, not just in the US, but globally. This is happening in different ways around the world, and it's going to continue to happen. The issue is how to manage the balance, and when do you go back to equity-based funding and so on. And it's going to be a complex and never-ending quandary for corporate treasurer over the next 5 years, maybe more. It's not easy.
The keywords being complex and cautious. Couldn't agree more. The fifth story that we shall discuss today pertains to the other C, which is compliance. Compliance is in the spotlight in an era of expanding regulatory scrutiny. Most chief ethics and compliance officers in the US expect the focus on compliance to increase based on expanding regulatory expectations and scrutiny, with the greatest pressure to enhance coming from their boards and regulators, said the KPMG 2023 Chief Ethics and Compliance Officer Survey Report. The survey report, titled Anticipating More Scrutiny, Forward Focus for Ethics and Compliance, draws on the perspectives of 240 Chief Ethics and Compliance Officers, or CCOs, from the largest companies operating in 6 industry sectors. As new regulatory obligations continue to present significant challenges to CCO's compliance efforts, the KPMG 2023 CCO survey report reveals that a majority of ethics and compliance leaders plan to demonstrate the business value of compliance over the next 2 years by promoting compliance culture as an enterprise-wide strategy. Jack, given that chief ethics and compliance officers are working to develop a strong compliance culture, do you think that compliance and/or chief ethics and compliance officers will become a true value add to their organizations in the near future?
Absolutely. I couldn't agree more with this paper. Some of it is very obvious, but the key phrase is getting business value out of compliance. And if you talk to a company who's just been fined 800 million, $1 billion, because they didn't comply with a certain regulation, all of a sudden compliance becomes really important, and you see directly the value. The issue I have with this piece of work is that the conclusion is they necessarily need to recruit more people in the area. I think the first thing is to work out exactly what the role is of compliance and what they're going to do and how to do it. Then it isn't necessarily that you recruit more employees. there's a lot of AI work, a lot of good technology work now, which the technical systems which are providing solutions and bringing all the different strands of compliance together. I think that in some ways is more important than employing full-time employees or more full-time employees.
Yeah, that's a great point by Jack. There's an awful lot to be analysed and to keep on top of if you want to avoid a whacking great fine and sort of the reputational damage that can do to an organisation. We've had some huge fines this year on GDPR. We had the biggest ever fine for that, which was 1.2 billion euros, handed down to Meta for transfers of personal data on Facebook from the EU to the US. AML fines, obviously, are a kind of constant. I think Crown Resorts down in Australia had one of the biggest of those of the year so far, $450 million penalty for breaches of Australia's AML laws. But there's also a lot more regulations coming up that corporates need to be monitoring and preparing for. There's a big push for mandatory e-invoicing across Europe right now, of course, which is something that you don't want to fall foul of when that comes in, because that can really impact your cash flows and cash management if you're not ready for that in the specific territory or nation within Europe when that comes in. On the tax side, we ran a story on CTMfile this week that shows how readiness for BEPS 2.0 is top of mind for CFOs. There's the European Commission's VIDA, which is VAT in the digital age proposal, which is coming up. So there's a lot going on in this space. And so it's vital for corporates to actually be able to get their hands around everything that they're required to comply with and understand the regulations and be able to act on them accordingly. So trends like, as Jack said, digitization and automation will be a huge help. You know, when I think about compliance, I just get a picture in my head of a huge bunch of files on an in tray on a desk, you know, and that's not that's not going to work. You're not going to be able to quickly find out your exposure or your compliance to a certain regulation in that world. The benefits of being able to digitize all of that, to see the complete picture on one screen in one system, and then on top of that, deploy analytics tools that Jack was talking about to that data that you can see. That, I think that's really essential.
Yeah, this is a new branch of corporate treasury systems. A whole new discipline is emerging of how to bring together all the different strands of compliance, and they are multiple. There isn't just a single one. In some ways, you could say it's becoming the most important thing of what corporate treasury does.
That is actually a very forward-looking statement, Jack. And, I actually think it makes a lot of sense. Finally, what is your choice for the biggest or most important story of the past week and why? Jack, if I may ask you to go first.
The biggest thing that's constantly emerging over the last few weeks is the complexity of corporate treasury is growing. And the treasurer / CFO are having more and more complex situations to deal with. The second thought of that is the only way through this is systems and approaches that bring everything together. It's corporate treasury and CFOs need to bring things together. This is how you get business value from compliance, business value from treasury, business value from risk. It's bringing everything together. It's no longer able to manage things in separate parts. You have to manage it together holistically.
Yeah, I'd totally agree with what Jack said there. And separately, I'd sort of highlight the digital euro story, just as it sort of shows how the future of payments, it's not that far away. You know, what you might be thinking is 10, 15 years away. Actually, it's very close to being a reality. And particularly, you know, the European Commission, I think I said in the story, there was a flurry of announcements from them this week. The digital euro one was the one that we focused on, but they also released the proposals for PSD3 at the same time. And that has a whole package of measures looking at everything from combating payment fraud, improving consumer rights, further trying to level the playing field between banks and non-banks, trying to improve open banking, and loads more. So there's a real push from regulators, particularly in Europe this past week, to take that next giant leap forward in payments and banking. So that's another area that it's sort of critical for treasurers to make sure that they're keeping on top of, and sort of maybe being a bit previous in terms of planning their systems and their processes around what's to come, because it won't be too long until it's here.
I'd just like to add an extra point to Ben's excellent analysis, which is that even though we say it's coming quickly, the trail takes a long time to complete. So ISO 20022 standardization is only just starting to emerge globally and have global impact. It's managing all these strands that is so difficult.
Thank you so much, gentlemen. Jack and Ben, a deep note of gratitude for your time and your precious insights. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.